Imagine applying for a credit card, a car loan, or even an apartment lease, and someone, somewhere, looks at a three-digit number and decides whether you're trustworthy. That number is your credit score. It's not random. It's not based on your personality. And despite what some people think, it's not a moral judgment. It's simply a prediction built from data about how likely you are to repay borrowed money. But what exactly is a credit score? At its core, a credit score is a numerical summary of your financial reputation. It tells lenders how risky it might be to lend you money. The higher the number, the more confident they feel that you'll pay them back on time. The lower the number, the more cautious they become. So let's get into it, right here, on History of Simple Things. Before credit scores existed, lending money was a very personal process. Local bankers made decisions based on reputation. If you were known in town as hardworking and reliable, you had a better chance of getting approved. But as economies expanded, especially in the 20th century, lenders needed a faster and more standardized way to assess risk. They couldn't personally know every applicant anymore. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac founded a company called FICO. Their idea was simple but revolutionary: use statistical models to predict credit risk. Over time, their scoring model became the industry standard. Today, when people talk about their credit score, they're often referring to a FICO score, though other scoring systems exist. What started as a business efficiency tool eventually became one of the most important numbers in adult life. So, what is that number really measuring? A credit score typically ranges from 300 to 850. The higher the number, the lower the perceived risk. But it isn't pulled out of thin air. It's calculated using data from your credit report. Your credit report is a detailed record of your borrowing history. It's compiled by credit bureaus like Experian, Equifax, and TransUnion. These companies collect information about your loans, credit cards, payment history, and more. From that data, scoring models look at 5 major factors. Payment history. Do you pay your bills on time? Amounts owed. How much debt are you carrying? Length of credit history. How long have you been using credit? Credit mix. Do you have different types of credit? And new credit. Have you recently applied for multiple accounts? Each factor carries a different weight, but payment history usually matters the most. In other words, consistency matters more than anything else. Here's something that surprises a lot of people. Your income is not directly part of your credit score. You could earn a high salary and still have a low credit score if you consistently miss payments. On the other hand, someone with a modest income could have an excellent score simply because they manage their obligations responsibly. That's because a credit score doesn't measure wealth. It measures borrowing behavior. It doesn't care how much money you make. It cares how you handle the money you borrow. From a lender's perspective, every loan is a risk. They're giving you money today in exchange for a promise that you'll pay it back tomorrow, with interest. A credit score helps them estimate the probability of repayment. Statistically speaking, people with higher scores are less likely to default on loans. Because of this, your credit score can affect whether you get approved for a loan, the interest rate you're offered, your credit limit, and even rental or job applications in some cases. A higher score doesn't just mean approval. It often means cheaper borrowing. Over time, that difference in interest rates can translate into thousands of dollars saved or lost. Credit scores are typically grouped into ranges: 300-579, poor, 580-669, Fair, 670, 739. Good, 740, 799. Very good, and 800, 850. Exceptional. These categories aren't arbitrary. They're based on statistical risk patterns. For example, someone with a score above 750 historically defaults at a much lower rate than someone in the low 600s. But here's the key point. Your credit score is not permanent. It changes as your behavior changes. Miss a payment? It drops. Pay down debt? It rises. Open several accounts at once? It may dip temporarily. It's dynamic, not fixed. Some people believe that avoiding credit entirely is the safest approach. No loans, no credit cards, no problems, right? Not exactly. If you have no credit history, lenders don't have enough data to score you. That's called being credit invisible. From a lender's perspective, no history can be almost as uncertain as bad history. Credit scores are built on patterns. If there's no pattern, there's no prediction. Ironically, to prove you can handle credit responsibly, you usually need to use credit wisely and consistently. There's a lot of advice online about quick tricks to boost your score overnight. Some strategies are legitimate, like lowering your utilization before a billing cycle closes. But the truth is, credit scoring systems are designed to reward long-term consistency, not shortcuts. There's no magic button. Building a strong credit score is more like building physical fitness. You can't do one workout and expect permanent results. It's about steady habits over time. So, what exactly is a credit score? If we strip it down to its essence, a credit score is a prediction. It's a mathematical estimate of how likely you are to repay debt based on your past behavior. It's built from data collected by credit bureaus. It doesn't measure income. It doesn't measure character. It doesn't measure success. It measures risk. Thank you for watching. If you have suggestions for our next video, feel free to share them in the comments below. We'll be sure to give you an acknowledgement for your contribution. Thank you for joining us on this journey through the history of simple things. Don't forget to like, subscribe, and stay tuned for more stories woven through the smallest details.